Good morning and welcome everyone to the Schwab YouTube channel we call Trader Talks. It is time for Trader Talk in today's market. It's the Thursday edition and I'm your host, Kevin Horner. Thank you all for being here this morning. Of course, I'm running solo with all of you today on this fine Thursday, solo at least on the visuals, but I am joined by my friend and fellow Schwab coach there, Barb Armstrong, in the chat. You can say hey to Barb in the Q&A. Barb will get to comments, questions that I'm unable to, but of course, want to hear from you throughout the entirety of the segment. We go about 45 minutes in total for Trader Talk here this morning, so your comments and questions can absolutely help drive the discussion today, so please feel free to utilize that Q&A. If you're not already doing so, following Barb and me on X and additionally on LinkedIn is a great place to find us. If those are your preferred social media locations, everybody, we would appreciate a follow in both. You can follow us there on X, Kevin Horner, CS, and Barb Armstrong, CS. Now we have the president, administration, and a few key members of U.S. Businesses in China, and there's been some positivity around that, but we're going to look at how the market is digesting some of that. Of course, we're going to look at a number of the key details that we've continued to look at here dating back to March with oil and its relationship to the broad market, and of course, as always, stocks in the news. So we're going to try to get to as many charts as we can today for all of you. So before we do, let's get to our disclosures. I'll remind you that everything we cover for you today should be considered informational and educational only. We do not make any recommendations here. We do not endorse a specific approach to trading. We do, of course, outside of risk management, that is a very key concept. But what we do cover here in Trader Talk is heavily weighted toward technical analysis, trend analysis, understanding the current situation of the broader markets. And remember to think of technical analysis just as one of those decision-making pieces, rather not the entirety of your decision-making. And so what that means is we discourage you from making decisions only off what you get in the way of technical analysis, but we do think it can be a helpful piece of your decision-making puzzle. Now, if this is your first time joining us here, we do a top-down approach to our market review. What that means is we start with our indices, we work our way through important industry groups, the sectors of the market that are moving, and then into stocks in the news. Typically, we spend that final 10 to 15 minutes reviewing the individual equities in the news, and that's what we'll try to do for you all today. So let us take a look at that S&P, which continues its upward trajectory. Really hard to be discouraged in any way by what we've had from the market here, going back to what would be essentially the end of March. We have just speaking of marching, I mean, we have marched higher quite well here since our bottom. In fact, taking that low on March 30th to our intraday move thus far, we are looking at a rousing 18% upward move here. So it's been aggressive, it's been strong, and all we're going to encourage once more here in this class is trend management. And you all know the way we do this. We start with some of those moving averages that have not come close to being violated, like that orange rising 20-day moving average, but we try and get even tighter if we can. And what I mean by that is we go with a faster moving average, maybe that 10-day, which we still haven't violated on a closing basis since March 1, when we recaptured it right here. So, because of that, trend traders have not been provided any real reason to make any additional changes or adjustments to their process or plan. And so what you've seen is traders holding position, not making reduction to position sizes or not building cash simply because you've not had a whole lot of reasons to do so. Now, that doesn't mean that some traders out there may not be taking advantage of the upward moves to be unloading positions in strength, for example. If you are the trader who likes to sell into strength, that's perfectly appropriate for somebody who doesn't like to give up profits, of course, and there's nothing wrong with that. But for a lot of you traders, you're waiting for trend changes, and we just don't have it here on the SPX. If we're going to get a little more granular, we can always look at that 1 hour view here. This is not a 6-month chart. Let me go ahead and remove that. Not a daily chart. This is that hourly look. And again, yesterday we were talking about this, the 50-day moving average coming into play, pardon me, the 50-hour moving average in this case, and that maintained with yesterday's lows. So, excuse me, not, I think that was yesterday. Let me just double check here. Yeah, that was not Wednesday lows, but the Tuesday lows came back and found the 50 hours. So, again, traders, if you're working with technical analysis in your beginning phases, one of the hardest things is just understanding trend and where trend changes. And something as simple as applying a simple moving average like this one, the 50-hour in this case, being that we're looking at hour-long bars on an intra-period basis, it can be just that simple. You don't have to make any changes, and there's nothing to suggest that any kind of move or price action below this would be a good reason to sell, but it would be a shift or a change. And certainly it's not that you'll notice here, this is one of those things where we didn't go anywhere as we were sitting on price, right? Just sitting on that moving average. This was a very tight range, but the market itself, the SPX, did not break down. You're looking for significant development, significant change in price that would detail a break of that moving average. And commonly, when we break a moving average, you want to look for like a level of horizontal support. So noticing in here, the last time we did, I'm going to zoom in on this just to give you guys a little bit of instruction. When we broke this down a little bit, you'll notice we were below that 1 hour here. This goes back to Thursday of last week, it looks like. And when we broke down, yeah, this candle looked ugly for a very small moment, but it quickly recovered. This was within 1 hour. It traded under that 50-hour moving average. It tested not just horizontal support, everyone, but that gap ledge. Remember the importance of our gaps and how gaps themselves can be areas that are strengthened in the way of support or resistance. And so while if you're watching this in the moment, quite live, you're maybe getting a little uncomfortable in that hour because this candle would have been filled in and read all the way down. However, if you were watching the hourly bars and you have been doing so consistently, as Kelly has noted here, this is one of the things that Kelly watches on the intraday basis, keeps a real close eye on it. You're not alone, Kelly. I think it's a good way, if you're willing to keep an eye on intra-period trends, watching the hour long, especially when we've made significant moves through areas of important resistance previously, well, then this can be really instructive as we are in the midst of the new trend. And at least it's certainly been instructive for the last 6 weeks or so now. So we are waiting changes, and you can see here that break of support gave a horizontal test at the basically filled that quick gap, and then it was back on trend. So here, this is just, hey, we're trying to figure it out. Notice the big takeaway about this area here is that we did not make lower lows. Even though we were dancing on that moving average, we didn't break down. We didn't get to a point where we even tested the last low we made. So this was really insightful. And then as we move off of it, becomes even more instructive for us because we were able to trade through this zone here, made new highs, and then pulled back to the moving average, and it's again right back on trend. So rinse and repeat. Pullbacks to the moving average here on the hourly of the SPX have been positive, and your opportunities to join in. Now, at some point, we know one thing that's going to change, but in the interim, that's what's been so far a reliable trend as we seemingly continue to push towards 7,500 on the SPX. We are now fewer than 25 points away there, everybody. Let's see. Oh, Chuck, I am not great on that McClellan oscillator. I'm going to have to go back and do some work for everyone here to get comfortable with the McClellan oscillator. I will apologize It is not something with which I have familiarity. It is something we can chart here on Think or Swim, but it is not something that I'm prepared to speak to. I'm going to make sure that that is something that I bring to the table in the future, but I've got some homework to do before I do that for you. But I appreciate the question. I'm going to put a pin in that, I hope, and bring that to the table in the future here. Okay, I'm going to put back all my moving averages. Let's move on through to the NASDAQ. We're seeing a similar move here. Let me clear out what's going on. I've got a lot of draw tools in here, everybody. My apologies. But the SPX and the NDX, you all know, have been very similar here in the movement. The 20-day moving average for a lot of us far too slow. And when I say slow, just give thought to what we're giving up. And when I say giving up, it's just this math, everybody. And all I encourage you to do is do this calculation here from where we are to the 20-day moving average. And this assumes that you would have an exit strategy below the 20-day moving average. Well, look at that line depth. That says 5.5%. That means you would be looking at giving up a 5.5% move to the 20-day moving average. And if you put a stop order beneath the 20-day moving average, well, now you're looking at selling in the vicinity of that 20-day moving average. That means you're willing to give up a 5.5%, 6% or more to be proven wrong about the trend and then be a seller. And for a lot of you traders, you would tell me definitively, no, I'm not willing to give up 6% of my position in terms of profits. I'm not going to give that back before selling some. Now, some of you say, I don't mind because I like the trend. I like the 20-day. It looks consistent for one reason or another, and you'd be comfortable sticking with your position. You're not the trader who is looking to be that active. And you might even say, you know, Kevin, this is all helpful, but I prefer the weekly chart as a trend management process. And no one would fault you for that either. Just what I'm getting at is I want you to know which are those trends that matter most to you, where you have the greatest comfort, and know whether you like to be a seller on strength or a seller on weakness. Ultimately, that's what it comes down to. Now, we obviously can change that. You can go with the 10-day. Here again, clean action above the 10-day once more, back to April 1. It is shocking how strong this has been. Now, again, we know these things change, but what we don't want to do is get in front of it the opposite direction. We want to trade what we see, not what we think. What we see is upside. What we see is bullishness. We have, once again, new highs. Don't be misled into believing that what's going up today has to stop going up. And if you're uncomfortable with the assault on these highs as we just keep moving upward here, everyone, well, remember, you can be bearish in view of the market without taking bearish positions. One of those scenarios just has you in taking more cash, which is to say selling a little as the market continues to climb, take advantage of those opportunities and get yourself into a more manageable, comfortable situation, something with which you're feeling a little bit more pleased in terms of, you know, letting the market do what the market's going to do, but you holding cash so that if and when things change, you're able to take advantage of those changes. All right, let's take a look at our small caps. Small caps here are a little flat today. Now, they've been kind of ahead of the pullback game. The small caps did make new highs, but did so about a week and a half ago. Now 6 sessions ago, I guess, and then pulled back to the 20-day moving average. We had this nice long tail on Tuesday morning, got down to test our horizontal support coincident with the 20-day moving average there. That worked out well. We've bounced off of it. This looks like it's reasserting the support of the 20-day. You'll notice, though, same thing. April 1 recaptured the 20-day, has held it on a close since. So we've got all 3 major indices here doing this once more, trading the same trend, working in a similar fashion. Now, the Russell, like I said, is a little bit ahead of it because it's tested the 20-day just this week, whereas the NASDAQ and the S&P have come nowhere close to the 20-day, right? They're both riding just the 10-day. It's been a little more wide range in the Russell here specifically. All right, and then let us peek in on rates. So we're looking at the 10-year here. We've got with the 10-year coming back, we had that good move into that 4.475 yesterday, but got pushed back again. We're going to want to see once more, do we continue to get pushed back from this? What we don't want to see is a continuation of the yields. Higher yields continuing to climb it will at some point start to be detrimental to small caps in particular, the broad market generally speaking, but a little more likely to impact small caps due to the debt-heavy approach that they commonly take. Let us also incorporate a quick look at the U.S. dollar here with the DXY. There we go. And so the dollar has been pretty range bound, and each time we found ourselves into the upper level here, notice the date on this. This is the end of March. This drop in the dollar has coincided with the rally in the U.S. market. So that is notable as well, not at all uncommon. Our biggest companies, our multinational companies, do better when the dollar is lower. And so as the dollar has retreated, it's additionally given lift to the broader indices here. And so if this is going to get back in gear, and for the record, from a technical standpoint, it kind of looks like it might be. We certainly have held some support in here. This is where things get a little bit notable. I think the big break of the trend line is one thing, but the alternate area to eyeball here in the short run is a midpoint here, a bit of a gap on the dollar dating back to that second week of April. So watch this level. If we rally and get pushed back from the dollar at this ledge here, well then if we get beaten back lower, we would anticipate perhaps the trend of the market continuing as it has. But a rally through this mid-level on the range would be a little bit of a headwind probably on the broader markets. It could be the impetus for the market to take that breather that so many of us traders are kind of waiting for, wanting to see maybe some pause in the trend, so a more comfortable opportunity to join into what's been working for the last 6 weeks. But it wouldn't shock us if if the market took any rally in the dollar as a reason for that pause. Yeah, definitely, everybody, I'm seeing a lot of great comments about this, and you are all correct. Mike Fairborn is fantastic. Mike knows so much about the technical aspects and can absolutely speak to those details on the McClellan. And I know that there are also some historical or archived videos here on the channel. So if you were to just search for McClellan, now this would be more, obviously, any historical conversations would be more of an education on the understanding of it more so than what it means right now. But there are some videos there on the channel archive available for you immediately. A few of those will be from our friend Lee Bull prior to his moving on. You might want to check those out as well. Okay, quickly, let's move on and hit our semiconductors. I'm not going to dabble here too long because everything I said about the SOX can be, or rather the NASDAQ can be applied to the SOX here. Continuation of trend. Looks like we're building a bit of a flag once more, having held the major levels here. Notice where we are, right back to the peak. And of course, if we can trade through to new highs as we know are not bearish. So a lot of traders will look at a potential breakout as a reason for expectation or continuation of the existing trend, which has been unbelievably strong. Let's go ahead, and I think it's about a 60% move here, peak from trough to peak. Actually, I'm wrong, only 70% now. So a heck of a move. Now, one of I know what I wanted to do. I wanted to go back to the NASDAQ here. Let me take this and just mention, I know a lot of traders have fear of the market, fear in general. I'm going back to a max weekly look at the, this is the maximum on a weekly basis that we can get on the NASDAQ 100 here. And the reason I wanted to bring this up is talking about the rally we're looking at here. Now, this is utilizing, I'm pretty confident, utilizing a logarithmic price scale. Yes, it is. Okay, that's what we want to do. And we have on here the 100-week moving average. Now, when you all start talking about bubbles and what we've seen from the market, is this a correlation to what we've seen historically? The thing that we need to be reminded of is that even in the midst of our strongest moves to the upside, we can continue to be completely and silly, irrational to the upside before we get those moves that are significant drawdowns. And the most significant drawdown, of course, was the dot-com move to these levels in early 2000. It was basically March of 2000 when we peaked. But yes, we did drop over the subsequent months here over the course of, let's see, that takes us to September of, September of 02. So March of 20 to September of 02, it was really rough. I mean, especially for somebody like myself who was new in the market at this time. I got going in 97, and so in 97, I'm feeling pretty smart, right? Because how hard is it to trade this market? Well, it's not. I just buy and hold and do just fine from 97 all the way to 2000. I felt really, really smart as a newbie. But the thing that I want to bring out is that when we see these moves, these things can continue upward in earnest in incredible percentages that we don't anticipate. For example, I'm going to zoom in here to just this period and take a look at when we found that 100-week moving average. This was September of 98, and we pushed to that ultimate peak 340%. Everybody, 340% from the low in October of 98 to the peak in March of 2000. That is 18 months, everybody, right? 18 months it kept rallying. And look at the final assault. Look at this move. From the basically where we went straight up, okay, this move happened over 23 weeks, 24 weeks. That is just shy of 6 months, right? 6 months, we went up 107%. Price can remain irrational far longer than we can continue to disprove it or continue to put our money on the table in an inverse view of what the market's doing. What I'm getting at is don't fight against it. It will change, and when it does, it will be significant. But what our job is to do is to manage our own emotional process there, everyone. I'm bringing this up not to tell you that this move is the one that's on deck. I don't know that that's what we're talking about. But what I am bringing up is take history for what it does. This is not necessarily, and I know you're seeing a lot of this on your socials, that this window of time today, what we're getting from the NASDAQ, from the semis, etc., that this is nothing more than a complete and total analog of what we've seen in the past. That's not necessarily the case, okay? But I know that's what's being presented by many pundits and many individuals on the socials here. All I want to encourage you to do is recognize that the market can move a lot further than we expect in the midst of these emotional moves. And it could be said that we're in the midst of an emotional move at this point, right? So much permeating the markets relative to AI. All we talked about in this period here was the internet. It was .com this and .com that, and I mean everything, right? So I just wanted to spend a minute on that as a healthy reminder of what can occur, all right? That's about it. All right, we're going to move on. Let's go to, I've got some other things to share with you all today. I wanted to bring one of our favorite charts for this class to the table. We've got that look at our sector relationships. Now, yesterday, if you joined us, we talked about how utilities and real estate have held up in trend, right? We saw yesterday, and we'll look at these charts momentarily, that they were holding up. But what stands out to me is that while utilities and real estate have done well in trend, which is to trade upper levels, holding areas or meeting resistance, these groups have been lagging the S&P, and that's because the S&P has been so strong. right? So these are verification or relationship of the move, so a relative strength visually versus the S&P 500. We can see that practically everything is lagging the S&P except for technology and for communications. So technology is leading the S&P higher, communications leading the S&P higher, and the rest have all been taking a breather here relative to the SPX. So they've been moving, okay, and yes, you've had some positive bullish trends, notably utilities, real estate, and some improving groups, as we'll see. But it's a healthy reminder that if you are of the belief that the way to trade is to trade only the groups that are moving upward, well, if you've been in utilities and real estate, you may be doing fine, but you're definitely lagging the SPX, right? Even though they've been bullish in trend, probably lagging the SPX. This is an encouragement when you visualize it. I think that leads more toward, hey, let's make sure we are diverse in our allocation of assets. Everybody, I am happy to share this grid with you. Let me go ahead and do so quickly here in the chat. Please be mindful that any scripts like this, grids like this that we share, these are not guaranteed for timing nor accuracy. There you go, everybody. And now let's look at some of those sectors, and just so I can illustrate what we were talking about here. If we hit up those, there's your utilities. So utilities is in a bullish uptrend, everybody. We're just in consolidation and holding on to the 200-day, but ultimately, if we're at support, that's an area where traders would look to expose money to a trend, right? Same thing on the real estate, except that they're at the top of the longer range trend. And of course, remember that there are additional risks associated with real estate investment trusts or REITs, and that's ultimately what the real estate group in the sectors is all about. It is not your home builders, as is commonly considered. So just be aware of that. Boy, the technical condition here on real estate is pretty interesting here. We are at resistance, building a bull flag on the weekly chart. This is one of those deals maybe where you might expect the yields to have to come down in order for real estate trusts like this to break higher. Otherwise, traders are going to feel more confident in, maybe the risk-free rate of return like the bonds than they would ultimately being in something like REITs, which commonly traders will move to when yields drop. One other consideration there. Now let's look at our leaders. We've talked about, we really can't say much more about technology. Everything we said about the NASDAQ and the SOX is common here in tech. Did want to hit up what should be improving sectors here. Financials still improving, but you can see the last 2 weeks here, last month plus, as we've pulled back, have not been really participating. Financials haven't. So the market has been rallying wonderfully, but financials have just been breathing. In fact, the financials made the move higher before everything else. They started to make that move higher before everything else here. Now, they bottomed out early on, made a really great move to the upside. Now the question is, are we going to see some rotation here? And this is ultimately what I think a lot of you traders are maybe giving consideration to. Having pushed into these elevated levels, having seen the market rally the way that it has, if you're trading and pulling profits, where are you putting that money to work? Is it going into cash? Is it going into risk-free rates like yields on bonds and things like that? Or are you going to expose it to the equity market and look at some of the laggers? Traders may be looking at financials here. There is a decent floor established here. I think the big takeaway is a break of the downtrend, a rally to new short-term highs, followed by a pullback to higher lows. Do want to see this hold up before we get any real comfort here, right? But we've held the 50-day, and for a lot of you traders, you're going to want to see getting back above the downtrend line off of the last month or so. So can we get above that downtrend line and back in gear? Because ultimately what we're looking at is higher highs and higher lows. And if we can make another higher high up here somewhere, now you've got what many traders are going to be a lot more comfortable with in a new bullish trend. Let's hit up that healthcare sector. Similar in scope here, everybody. I have a lot of lines drawn in. We are at the downtrend line, also at the confluence of our moving averages, the 50 crossing the 200 to the downside. This is a very important spot for healthcare. We definitely need to get through this because the 5200 cross occurring, if we push through, we still need to capture the ledge here at 1745. We've got to create a higher high because, simply put, if we don't create a higher high, then the greater likelihood is that the death cross we're looking at here carries, and that we get at least a pullback for a test of the lower lows, or the matching lows, that we've seen here before. I think this is a tricky and delicate spot for the healthcare. Now that we could say that RSI is showing improvement. We have tested this ledge of support about 3 or 4 times in the last 6-7 weeks. Having done so, our RSI is giving us higher lows. So I think that makes a lot of sense from a standpoint of validating support, if nothing else, but it doesn't tell us anything about can this thing be trending upward until we make that higher high. And again, that's the level here at about 1745. So very important spot on healthcare, and it just happens to coincide. If I moved my my line here, I'm just going to extend it to the left. Look at what it catches. It catches that extended low that we saw back here, and it was support, and we bounced off, made a high, and then we paused at that exact same spot before we broke down to make our matching low. So again, reiteration of the importance of that level. And then industrial, actually we'll hit industrials first. Kind of still holding in here, everybody, but the trend is not active, so to speak, right? I mean, the time to consider industrials was the test of the 200-day back here, and now we're just in basically consolidation. Now, there's nothing bearish about the chart. In fact, many traders would tell you that the 20-day rising the way that it has, and our ability to maintain the 20 on the lows, has been a positive for industrials. But it's not trending the way that it was back here from November to our peak in late February, right? So that seems kind of notable here. And then the materials I wanted to look at, and we're going to use this as a jump off to get to our precious metals here. The materials are really just meandering a little bit sideways right now. Thought earlier or late last week we might be able to get a breakout, but we've just not been able to push through here. Now, there's been a little bit of a back and forth with gold and silver. So let's take a look at those. A little bit of a disparity between those here. So gold has still not gotten back above that 50-day. And look at how the 50-day has been like a magnet for resistance, hasn't it? My goodness. And we just stay beneath it. Ultimately, we're learning we are in, at best, a consolidation period here. And we can take that look at the 50-day, and then apply the RSI and what we know about the trend to the RSI, and we see where have we rallied. Well, we've still not been able to get above the 55 zone. And we know that in the midst of a bearish scenario, a bearish trend in the near term here, that rallies of the RSI into the 50 to 55 zone, that can be considered to be overbought conditions. Now, we can say that because we've seen lower lows, lower highs. We have a downtrend from the peak up here. Let me see if I can draw that in. Yeah, basically right about there was our peak. Here we go. Sorry, everybody. Seemed to get a little bit of a lag here this morning for some reason, which is real interesting because I've got kids at school not gaming or anything today, which I would have expected some lag from. But basically, there's a downtrend line from the peak down through the 50-day right about there. And in that window, the RSI has just gone sideways. And ultimately, by not moving through, the RSI not moving through the 55 level, we call that more or less a bearish regime here and validation of the trend. Man, that lag on that one was kind of interesting. Took quite a while. Okay, so ultimately what we're seeing is the gold not yet above the 50-day moving average, but looks a little different here with the silver, as silver has broken higher out of my triangle there and holding on, made a new short-term high. At least it crested the highs that we needed to clear here around 83. By the way, I should mention we've used futures symbols on these, even though we're not, encouraging you to check out futures from a trade standpoint. We use it for the purpose of trend management and understanding more than anything else. But I think that's notable that silver, honestly, silver breaking higher in advance of gold really shocked me. I was not in expectation. That was not what I was expecting at all. Now there is clear resistance here we can see. So for those of you silver individuals, maybe that 89.90 becomes a very important zone here because we've been beaten back from it a couple of times now. So maybe keeping an eye on that in the near run. And then, hey, we're looking at futures, so let's go ahead and bring up my other popular chart with all of you, and that is the visual of the S&P, the VIX, and oil. So same situation here, everybody, utilizing the future symbols, but not validating them or encouraging you to trade futures necessarily, but see the relationship between them. Oil spiked into that 103 ledge, but has pulled back. The $100 level continues to be important for us, and yet the longer this conflict goes on, the more it seems the market is just discounting everything that's happening there in the Middle East. It just doesn't seem to want to care. So that's knowledge for us. I don't know if we can hang our hat on that moving forward, but until things change, my encouragement is, hey, we go with what's working until it's not working, right? And then we go from there. All right, now let's bring in some of those individual stocks. We do have some stuff moving around for you all today. In advance of the market open, we did have some good movers here. So let me see. All right, so we had a big move in Cisco. Let's put Cisco up there. This is one of the reasons maybe some of you traders are thinking, hey, it really is 1999 and 2000 once again. Cisco jumping 18+%. Now we're up only 14% at the moment after the network equipment maker touted a double-digit percentage growth for sales and profit in their fiscal third quarter. So that was lovely. A report out, and by the way, bear in mind, when we get these big moves like this, first of all, Cisco has been tremendous. This was a wonderful rally against the 20-day moving average once it broke resistance. And you ever wonder why traders like to buy or are open to buying stocks breaking out, making highs, etc.? It's what you got here. Broke out, flagged right to the breakout zone, and then took off. If you have only owned this for about 3 weeks, you might be up about 30-35%, right? Now, if we take a look at management standpoint, some of you traders might just look to exit with an order maybe beneath the gap level, maybe the gap level itself right to the penny, maybe the gap level by the measure of the average true range. So you might take the low of the day and go beneath it by the amount of the ATR. In this case, that's $3.62. But, these are just trade management processes. And again, we traders have to know, what is it we like to do? Do you like to be elevating and using stop orders like this? Remember, when we do stops, they don't guarantee our price in any way, but they do help us manage our risk and try to maintain our profit scenarios here. Cisco, in this case, everybody, there's your long-term, your all-time maximum at all-time highs. So now granted, it took a long time. It took a long time for it to get there, but it did make back to all-time highs. Okay, also moving, we had NVIDIA up. on a report out of Reuters here. So let's see if I can get NVIDIA in the chart. There we go. All right, NVIDIA shares were up 2% pre-market, and here we're up about 2.4 or so. Looking for, of course, brand new high today. And the headline is there, out of Reuters, the Commerce Department has approved 10 Chinese companies that can buy NVIDIA's H200 chips. So that certainly stands out. Again, I mean, I'm not sure what to say about NVIDIA here. The best opportunity in this late, or as always, hindsight viewpoint, was the break to new short-term and all-time highs, the pullback to the 20-day, not a surprise, and then the 20-day leaving us with an opportunity to participate. Stock is up 35 points or so here, about 20% just in the last 2 weeks. Wonderful, wonderful move there. Probably getting a little bit of enthusiasm as well from the China visit. And then we have Marvell. Marvell today moving to the down. Well, I had it up. Hang on a sec, everybody. Let me read that again. Yeah, there we go. Moving upward. Had a 5% move. We're up 4.5% now. After the chipmaker received share price upgrades, they got it from Goldman Sachs, took the target on Marvell from 100 to 125. Obviously, it looks like Goldman a little behind the game here at 186 a share, but Bank of America also raised their target, was previously at 125, now at 200. So that seems notable as well. All right, now let's see here. I had lots of headlines there relative to a couple other companies, but I'm going to move to make sure we get a couple of upgrades in the mix here. So, first of all, we didn't look at Staples, so let's pull up. Oops, that's financials tech. There we are. There's my Staples. So we talked yesterday briefly about Staples moving to resistance, and Staples is still at resistance. I thought that was kind of notable, but this could be that space that takes on profits and proceeds from stock traders looking to move out of tech if and when they take their breather here. And in that space, Starbucks, I think of Starbucks. See, I think of Starbucks as that staple. I don't know if everybody does, but nonetheless, Starbucks' chart has really improved of late. Now, they got an upgrade today at TD Cowen, upgraded to buy from hold with a target at 120. Previous target was 106. You all know how annoyed I get when we see stocks trading at 52-week highs and then we get upgrades. But I wanted to peer in on this, probably about the last 5 or 6 year chart on this one, everybody. Let me clean this up for us. So here it is on the weekly. It's really been consolidating over the long time, right? But we can see we've got some pretty clear areas of support and some potential clear areas of resistance. And I guess it all comes down to how you truly like to draw your lines. We know that, technical analysis is an art. It's by no means a science, but there does seem to be a ledge here that we've been pushed back from, and it happens to coincide at 118. And again, TD Cowen just tagged it for a target of 120. Not to say that that's a guarantee to have been achieved, or to be achieved rather, but it is notable. The other thing that's notable is just the range and the longevity of it. It over the last 6 years has not been trending on this longer range basis, and so a move through that 120 level would be a development of note. Not to say that that's coming, but you can see that there's at least a bit of bullishness over the last few months, and we are trading at 52-week highs, and it's not that far off from these previous level from which we've retreated, that 118 spot. So I wanted to make sure we got that one on the table as well. All right, Everybody, we are just about at time, so I'm going to use that to wrap us up. I always appreciate you joining me, though, on a Thursday when I am solo. I do love hearing from all of you. I did notice a question there about the grid. Let me just mention the grid that I shared in terms of getting that loaded. You don't want to click the grid, right? You want to just copy the actual detail that I've provided, that script, copy the script verbatim, and then you take it up into your setup here and you just paste it as is into the share functionality here. So setup and then open shared item, and then make sure you hit preview so that you can then upload it. And then one other note here, when you do this, everyone, it's important that when you load it in here, go ahead and give it a title so that you are easily able to locate it after the fact. If you put it in there, the default is the date, and it puts the date in verse. So basically 2026 0514 or something along those lines. But that's more difficult to locate than if you give it an easy to find name. So that would be my additional encouragement there. So with that, thanks again. Make sure you're following Barb and me on X. If you like the conversation, you can hit that thumbs up for me down below, which does help us out as we get this reviewed and archived and available for the rest of you who couldn't make it for the live session. So with that, have a great rest of your Thursday, everybody. I'm off to Chicago. If you're going to be there, stop by and say hi. I look forward to catching up with you all again real soon.